Okay, well, tonight we're going to talk about a balanced portfolio. So it's all the ideas that go together to enable you to kind of build up, a good selection of things like commodities, FX, and indices, but also, again, just to give you an idea and a bit of an overview of how you can approach the markets. A lot of people like to, pigeonhole themselves and say I'm only a footsie swing trader. But in matter of fact, we can be any kind of trader we want. Once we understand the basics of fundamentals and the technical kind of side of trading, it doesn't really matter what the product is. As long as we understand the rules of the game we're playing, then we can trade accordingly. So again, just trying to give you some ideas and to understand how we can approach the markets and what's the best way to trade. So before I start, as always, the risk warning that spread betting and CFD trading can have a high level of risk to your capital and result in losses that exceed your initial deposit. But it will be suitable for everyone, so please ensure you fully understand the risks involved. Information and comments provided herein are in no circumstance considered an offer or solicitation to invest. Nothing herein should be construed as investment advice. Information provided is believed to be accurate the date it is produced. Again, educational only, guys, but it's personal opinion of the moderator at nitrade.com. Content does not constitute financial investment or tax advice. Intro.com does not accept any liability for the content and comments made during this session. So what is a balanced portfolio? Well, the definition of a balanced investment strategy is really a portfolio allocation and management kind of methodology aimed at balancing risk and return. So such portfolios are generally divided equally between equities and fixed income securities. So again, all the different products we can trade and all the different viewpoints we can take of what's important within the market. So again, in times of trouble, when the markets are very, very volatile and a lot of uncertainty, then commodities again become somewhat of a safe haven. So we've seen that gold has spiked over the last few years on the back of the credit crunch. And then again, other currencies like the Swiss franc has seen, is treated as a safe haven and generally goes up in times of crisis. So again, it's about finding that right kind of balance and that right kind of mix between what the market is trending and finds valuable and what it's not. So again, the whole point is people don't like sometimes volatility, but volatility and movement in the markets generates trading opportunities. So by focusing on what's moving, you get a much better idea of where money can be made and how your trading strategies can be best used. So really for me, you have to understand if you're a long or a short-term trader. I've actually just done a new course for InterTrader, and it's all about building your own strategies. And it basically comes down to, do you hold overnight positions? Okay, so if you're a short-term intraday trader, you don't hold overnight positions. If you're longer-term and looking for the bigger picture, then you do. So that's basically how you can separate your trading strategies and define if you're a short or a long-term trader. If you don't hold overnights, then you're an intraday short-term trader. It's as simple as that. So when you think about investing and trading, you have to decide, again, the time periods of how long you want to stay in trades for. If you trade big enough size, on a 5-minute candle, you can make as much as other people can in a day. If you want to make, a lot more money over a steadier period of time, then you have to invest over days, weeks, months, years even. So again, it's by identifying your risk and therefore your exposure. Okay, so the more time you hold trades, it's two ways of looking at it, okay? The longer you hold a trade for, the less risk you're actually taking on because you're spreading your risk over a period of time, but the more exposure you have, because the more time you have your open positions in the market, the more you're exposed to non-trading events, So it's different ways of looking at it. The whole point is when you've got an open position, you've got exposure in the market. So again, if you're holding overnight positions, if war breaks out or there's some sort of major geopolitical issue or an earthquake, for instance, you're going to be, susceptible to them exposures because you still have open positions. But if you're a short-term trader, you're basically watching the trade, you're in and out of the market, understanding what's happened as it trades. So the short-term trading basically versus long-term investing. So the longer hold the position in the market, the more events, both technical and fundamental, you're going to be exposed to. So that's the unknown. Okay, so the market will trend, create peaks and troughs. That's its nature. So the extremes, as seen in the markets with new events and information, can affect both the supply and demand. So think about this statement: the longer you hold a trade or investment, the more potential profit or loss you can make. But the shorter amount of time you hold a trade or investment, the less risk you're actually being exposed to. So again, it's that risk reward of understanding what you want to make out of a trade. If you want to make 1,000 ticks, 1,000 point movements out of a trade, you won't be able to do that in a day. Not even if another 9/11 happens, it's very unlikely you'll get that kind of size of move in one day. But if you want to get 1,000 ticks out of a move, you might be able to make that in a week, or if the markets are really kind of moving very aggressively over a series of days. So think about what you're trying to achieve. Okay, if you're trying to achieve a great amount of profit from your initial investing or trading point, then the likelihood is you're going to have to hold this for a period of time. If you're just looking for a small amount of money out of individual trades, then again, this comes from being in and out of the market and picking the product that you choose to trade. So once you decide which statement suits you, you can then understand your risk reward. And that risk reward basically sets the tone for your trading strategy. So again, the trading strategy you adopt is down to you. The part for me really that sets traders apart is that if you want to be an intraday trader, you're more of a momentum / scalper, looking for them short-term blips in the market in order to profit. Again, and if you're a longer-term, maybe swing or position trader, you're looking for that longer-term view. But it doesn't mean you can't still be in and out the markets quickly if you have a longer-term view. Okay, so you've got to be either a short-term trader, you're a longer-term investor, or what I suggest, a balanced portfolio holder. And that really encompasses everything we can try and do. Okay, you can make sure you portion your capital, the amount of money you have to invest, and then hold some where you have a long-term view. Maybe your long-term view is that gold has peaked. All we're going to see from now on is more kind of transparency in the markets, so gold will taper off and gradually be less valuable. So maybe that's your long-term view. In your short-term view, maybe you think the US stocks are going to be a little more valuable in the global sense more than European stocks. Or maybe the dollars will be more prominent to trade and more prominent in investors' minds than the euro. So maybe you buy the dollar against the euro. So again, all these different things you can start to understand and build a view on. It's always good to have a view of what you think is going to happen long term, because that can set a bias for your intraday trading. But again, when you're intraday trading, you're just looking for them movements. So you want to be kind of almost market neutral. So when the market's looking strong and going up, buy it. When the market's looking weak and trading down, sell it. You're not really holding on to a long-term view. You're just looking to get in them intraday market movements and take some profit. And that's what spread betting gives you the ability to do, buy into strength and sell into weakness. So a short-term trader, there's obvious advantages. Okay, so you're much less likely to be exposed to fundamental and technical moves, because the fundamental moves that you're going to hear about will be figures like non-farm payrolls. So you know that if you're trading up until 1:30 tomorrow afternoon, you know that non-farm payroll is coming out, so you can get out of a trade. Okay, if you're going to be a long-term trader and you're holding it over a number of months, you know you're going to hold your position over at least one non-farm payroll, which are very volatile exposure points in the market. And then it gives you much more ability to use your capital on a single position. Okay, so you can see maybe a piece of information comes out or a figure, or you see a particular trend, and you can use all your capital on that one trade and then take out your profit. Whereas if you tie up all your money in a long-term position, you can't use that money to get in and out. So again, you can trade multiple products simultaneously as long as you've got enough capital. And again, you take advantage of the short-term blips in data, in news events, in technical charting that a long-term investor just wouldn't see, because you're looking at the charts and opportunities all the time. And also, you can really manage your trading hours and your commitment. You can say, I only want to trade the busy periods, so maybe at 10 o'clock and 2 o'clock in the afternoon. Okay, so if you want to be a long-term trader investor, maybe you have to look at the markets quite often to find out when you actually put your trade on and get a view. So obviously there are disadvantages that, if you're going to be a short-term trader, you generally have your charts open all the time and you're looking. You have to, understand your margin requirements if you're trading multiple products. And then over trading is a big issue if you're an intraday trader. People like to be in and out, constantly getting, these small-time moves. But you can then be over trading and not see the, any kind of bigger picture. Then obviously the more products you trade, the more research you'll have to do. And again, if you're over trading, you're not having, that presence of mind to sit back and wait for that really good trade in the day and just trade that one opportunity. So short-term trading and long-term investing have the problem. So I would say, you try to balance it out. Take a short-term view with the markets, tie in with your strategy, maybe a long-term view, portion maybe 30-40% of your capital and use that on a long-term trade. So obviously long-term trader has its own advantages. So you get the full extent or the greatest extent of any directional move. Okay, if you see that the trend in the S&P, it's gone down, but you won't be able to, in the last recent period trading days, but you won't be able to get the full extent of that down move unless you'd held the trade overnight. Okay, you can say that yes, well, buy, I'd sell every top and buy every bottom every day that it trades, but it's not quite as easy as doing that in real life scenarios. So if you want to get the most out of a trade, you generally have to put it in. The other advantage is you have to define stops and targets. You say the market's going to go from 1600 to 1700. Okay, my stop's at 1550. Simple as that. Okay, whereas you've got your intraday trading, you're constantly reassessing what you're doing. So you can build a strategic portfolio with a bias. So maybe you think that American stocks will go up and European stocks will go down. Then, that's your bias long term. You can fade fundamental news and events to a certain extent. Again, the long-term traders like to do this. That they'll encompass a number of non-farm payrolls, interest rate decisions, and they'll just let the market do what it needs to do. The long-term view is still the market will go in one direction. Okay, and then you set times for your entry and execution of your portfolio review. So again, you want to check if your view's still right, if the strategy's still right. So obviously disadvantages, unless you're constantly monitoring your positions, and there's less chance of adding to pullback, so when the market overextends. So you're not quite as involved in your trading activity, but some people prefer that. Some people like to put the trade on, know where the stop is, and then just leave it to run. Okay, you have to wait for your profits until you take that out before you reinvest your capital and make other trading calls. It's difficult to counter trend as well when you're taking a long-term position, because you have to wait for the extreme of the market, to change around the overall direction. And there's no kind of bonuses, I guess. So non-farm payroll I see is a bit of a bonus when you're trading. It's every first Friday of the month, and you can trade it or not. If it's a particularly out of line non-farm payroll, you can make money from it. And you generally won't do that if you're holding long-term positions solely, okay? Because you won't want to, contradict the trade that you're doing right now. And really, there's less personal involvement. Again, if you give your money to a financial advisor and say, here's X amount of money, please invest this for me, and I'll look for my returns in 5 years. You basically just check your statement every month, every year, and then that's your trading career. So really, if you want to be a long-term trader, that's the kind of methodology you have to look for. Agree that you're going to tie up that capital and that money you've invested for X amount of time and not touch it, because that's your plan. That's your trading view. So some people, like more involvement with their own money, but again, it just depends what view you're taking. So really, a balanced portfolio is when we're trying to take the best elements of a long-term trading strategy. So key things to remember when you're trying to build up that balanced portfolio is have your rules set and ready before you start to trade. Don't ad hoc start to make your long-term and your short-term decisions. So don't say, well, I think gold's going to go down for the next 6 months, but then after that going to go up. Have some longer-term view in mind. Then set out the maximum amount of capital you're willing to expose on those rules. Okay, so have a set amount that you're going to invest for short-term trading, and a set amount you're going to set for long-term trading. And again, the golden rule of trading: only use capital you can afford to lose. Okay, a balance is just that. No longer and shorter-term trades with a variety of products. So encompass your commodities. Look at your indices. Check out your currency pairs. Is the euro going to be stronger than the dollar? Okay, all these things you need to look at. Then pick out what you think is going to be better invested longer term, what's going to be more volatile in the shorter term, and then use the rest of your margin and your capital to trade them short-term intraday movements. So again, when I worked at PricewaterhouseCoopers, one of my first jobs, I used to invest money for H&I. So the kind of idea of a balanced portfolio is all we ever brought forward. It's basically no different. It hasn't really changed over the years. Have some stocks, some indices, some CFDs, hold some currencies, some government bonds and commodities. Balance it out. Have your tech stocks as volatile. Have your government bonds as your safe house. All these different things are generally, haven't really changed, since the time of when we invented different products. Obviously, again, depending on the economic cycle, different products will experience different amounts of volatility. But the basics are have some bonds, have some currency, have some stocks. And then make sure the balance, don't be too overexposed. For instance, don't have too many American stocks and hold dollars because they're priced in dollars. So it's just really kind of, more basic common knowledge and thinking about it in the right way, that there's no point overextending, overinvesting in one particular area. The whole reason, you can trade the hundreds of different products on InterTrader, on any trading platform, is that, you have the variety to dip into what's moving when and where. So the real steps to balance, to building a balanced portfolio, for me, really are this. The key components, you generally have 10% of stocks. So individual stocks that make up the indices. So if you take the FTSE, for instance, the FTSE is made up of different sectors of shares, banking shares, energy shares, retail. So think about, what it is, what constitutes it, what constitution it is of the indices that it measures. So BP, it's about 6%, I think, of the FTSE. So again, if you think the FTSE is going to be bullish, and you think oil prices are going to go up, then buy some BP shares. Okay, and again, it's your long-term view. Remember, they're priced in pounds, they're part of the FTSE. So 10% of individual stocks will give you that flexibility to make a good judgment of what's real value. And again, keep your basic view of what you think is going to happen in the UK, what's going to happen with the FTSE, because again, these constitutional shares will make up and move in the same direction as the overall indices. That's how they work. So maybe 10% commodities. Again, it's down to personal preferences. Remember, the majority of commodities are priced in dollars, so bear that in mind if you're buying currencies. So again, you can have hedging opportunities, buying Brent, against WTI. So maybe, you'll buy long-term gold, because let's face it, we're not making any more oil. The world, as far as I know it, is heavily reliant on oil. I'm not driving my electric car yet, so the long-term view for oil is it's generally going to go up. Gold, maybe different. When I've done this presentation, gold was at 1.666. It's not that high anymore. And my kind of view is that, gold's certainly going to drift off towards 2015 and probably be about $1,000. So that's a long-term view. So commodities, again, build up a long-term view of where you think, coffee, Brent, gold, silver, anything that's tangible in the world, where it could end up in a couple of years' time. So 30% is generally, good to have some currency. So for me, currency, the most fluid markets in the world, 4 trillion traded every single day. So again, if you're heavily invested or, you like your commodities and that builds up a bigger part of your portfolio, don't be too dollar biased because, again, the dollar, it prices most of the commodities we trade. So maybe you think long term the euro is going to recover. It's over the worst and the euro is going to strengthen. That's not my personal view. I think I wouldn't take any euros if you gave them to me. So I'll be buying every currency I could against the euro, expecting it to go down. So 30%, again, you can trade that however you want. It's a lot more fluid and liquid. Take a long-term view or short-term, trade opportunities. Then 20%, your indices. Okay, this is bread and butter. It's okay, generally when you go to an investment advisor, they'll start buying, key points in the main indices. So maybe you think the FTSE is going to outperform, so you start to buy some long-term FTSE. Maybe you think the S&P's topped out now and it's going to move down. These troubles in the with Syria. Maybe the S&P and American shares are going to be less appealing in the coming years. Maybe Nikkei and Japan are going to be the ones, the new emerging markets that take over. So bonds, again, I would say anywhere up to 50% in your portfolio for bonds. Government bonds, they're not guaranteed money, no matter what anyone says. But let's face it, if the T-notes, for instance, in America, doesn't hold its yield and can't pay its dividends, then, the world's pretty much ended. If America goes bankrupt, then that's the end of the world. So it's irrelevant what bonds you have. So bonds, obviously, pick out the safe countries. Maybe you're going to be taking some bonds in the powerhouses like Germany. Maybe see some value in Spain. Maybe Spain's over the worst and it's only good things are going to come. If you're very kind of risky and you think Greece is going to pull itself out of the hole, buy some Greek bonds. Get a great yield on that. Me personally, stay well clear. I'll be buying Germany, UK, and US, and that's it. Don't really understand China and Japan. Stay well clear. So it'd be the main kind of Western powers where I'd want to hold bonds. So that really, would bring you a 100% balanced portfolio if you'd split your capital between trading short and long term in them kind of proportions. So again, for a balanced portfolio, it depends how involved you want to be. If you want to check your portfolio once every 3 months, and it's high interaction. Maybe you're checking and changing your positions all the time. So maybe you bought your 10% stocks, commodities, and 30% currency. Then the rest of it, your bonds and indices, you're trading intraday. So maybe you want to trade them every single day. So that's high interaction. If you want to leave it between 4 months and 12 months, that's kind of medium interaction. You can just set the basic trend and tone and then trade accordingly. Again, if you want to hold things to a low interaction, put your trades on and check it every year, every 2 years. Again, if you want to catch the big moves in the markets and the overall direction, then that's the time period you're looking to hold it over. So really, again, these are just basic guidelines, but for me, 10% stocks and commodities, 30% currencies, 20% indices, 30% bonds. That will give you a good base of being able to interact with the markets, get involved in a good way. So that's really what I'd be looking for if you want to build up any kind of real sustained interaction with the markets. The other side is you just go 50% and do one long-term trade 50%, and the other 50%, that's your interaction. So maybe you just trade a mixture of bonds and currency, or currency and indices in another 50%. So you can be involved in the markets much more often. It's the whole point is of having a spread betting account is you can be involved in a trade for a matter of minutes and make good enough money. So it's all about utilizing your capital in the right way. If you want to take low risk and tie up capital and then just let it work for you, that's long-term trading. It's picking the overall trend and then letting the market do what it needs to do. The other side of it is if you want to be more interactive and get involved in the market much more often, then you want to be able to free that capital up and then trade the short-term opportunities the market presents. And it will present an opportunity every day. But again, it depends if you want to be looking at your charts every day, if you want to be listening to the fundamentals every day, or if you just want to put your money and take your chances and sit back and let the markets do what they need to do. I mean, the overall trend is when we look, that the indices will continue to rise. Commodities will trend up aggressively, then trend down aggressively. And currencies, again, it fluctuates between what is the in vogue currency. So again, entirely up to you how you get involved in the markets, but this for me is the right kind of balance, the right kind of way to make sure you're involved without taking undue risks. Okay, it's a fairly short presentation, that, to be honest, guys. It's just to give you an idea of how you can get involved. For me, what I would do is, if you've got, for argument's sake, you've got £10,000 to invest, I'd put £3,000 or £4,000 towards a longer term trade, maybe over 6 months to 12 months. And then the other amount I'd split between products you like to trade, and then just use that for small term opportunities in the volatility. Maybe apportion £2,000 and only trade that over big data, over like interest rate announcements and non-farm payrolls, and then the other 3,000-4,000 or so use for your margin to be able to trade currencies and commodities, whatever's trading and trending heavily. Do you think you can make a short-term bet with and make some money? Any questions, guys? Any thoughts on that? Anything you'd like to ask? Obviously, we've got the big one tomorrow. Non-farm payrolls at 1:30. So I think this is the 30th, 31st, 32nd non-farm payroll I've traded. So I've gone for 170,000 figure tomorrow. So I'm expecting a little bit better than analysts, but we'll have to see. Again, do we think the worst of it's over? Is the US going to have good data that's going to take it, the markets hard and aggressively up over the weekend, when we think we're going to get some action on Syria? Let's face it, we're thinking the Senate's going to push this through by tomorrow, and then I wouldn't be surprised if they were bombing Syria by Saturday morning. So the markets could go up on the back of a good non-farm payroll, but then bad, and downwards on the back of intervention in Syria. So again, it's the fundamental view versus the technical view, isn't it? Okay, well, I'm glad you understand that. Like I said, guys, it's probably not the most interesting presentation I've ever done, to be honest. It's again, I like to diversify things. I like to give the benefit of all the things that I've learned over the years. And the balanced portfolio, this is things that like it or lump it, the senior partners at PwC used to charge £1,000 an hour for. So it's all worth knowing, guys. There's all the things I've picked up on my travels. And when you're looking at investing, even short or long term, these are the basic kind of principles you need to look at, and they don't really change. So that advice, that people charge so much money for, again, I'm giving it for free. What you do with it is entirely up to you guys. So listen, guys, we'll keep it short tonight, but do look out for the non-farm payroll at 1:30 tomorrow. I'm expecting a better than expected figure, so masses and masses of volatility. Anything else you want to know, guys? Just tweet me at Steve Ruffley or email me. I'll just put the feedback down as always, so you can just fill that in. Anything else you want to know, guys? Please let me know now. Just type it onto the chat window. Anything you want to know, just let me know. Again, plenty of opportunities in the markets right now. Plenty of fear. We saw the market sell off aggressively this morning. From that bomb explosion in Damascus, only to rally up on the back of fairly in line or slightly better than expected US data. Now we're kind of flat at the minute, just waiting for the next kind of big move to happen, which will be obviously tomorrow afternoon during non-farm payrolls. Okay, guys. Well, listen. Anything else? Let me know. But if not, we'll keep that brief tonight, and I'll speak to you all tomorrow, hopefully. All right, guys. Have a great night, and it's been a pleasure. Thank you.